Hey YouTubers, welcome back to my channel. If you're new here, my name is Sai. So recently, a fellow YouTuber I follow over in America, Graham Stephan, did a video where he basically said that he bought a bank. Now if you want to go and watch that video, you can check the link down below in the description. But what he had actually done is invest in a new company called Yotta. And what Yotta actually does is that it offers users a savings account. But unlike your traditional savings account, Yotta gamifies the whole experience by turning your savings into something like a giveaway. Now the way that they do it is with every $25 that you save, you get entered into a weekly draw. Now in that draw, you then have a chance to win up to $10 million. And basically in general, what the online community has calculated, that the average prize pot would usually top up their low interest rate to about 2.5%. But this whole new idea of saving is not something new, but it's actually pretty old, especially over here in UK on our side of the pond. Because back in 1956, the Chancellor back then announced a scheme called premium bonds, which was a scheme that helped encourage people to save their money during a post-war era. So in today's video, I thought I'd look into premium bonds in UK in a little bit more detail, and then compare them to how they stack up against dividend stocks. So while you watch the intro video, make sure that you head down and smash that like button until it turns blue, so you can help the YouTube algorithm recommend this video to lots more people. So first of all, what are premium bonds? So currently in the UK, you might have heard of a company called NS&I, which stands for National Savings and Investments. Well, they have a product that they offer called premium bonds. Now NS&I are not a bank. They are considered as a financial institution because they are essentially a government saving bank. Now with the premium bonds, they actually define this product as a fun way to save, with a chance to win tax-free cash prizes each month. Now, by saving money with a government saving bank, what you're actually doing is lending your money to the government. And then in return, the government gives you interest on your money. Or in this case, within the premium bonds account, you're given the chance to win cash prizes. So in essence, it's basically like putting money into the lottery. The only difference here though is that you're not losing money for your lottery ticket. Instead, you're actually saving your money. Now currently over 21 million people in UK actually have a premium bonds account, which is nearly a third of the whole of the UK population. And each month, premium bonds claims to create 2 new millionaires. And because NS&I are part of the government, they can also guarantee that 100% of your money is safe, as they are the only people in the whole country who can say that they are backed by the HM Treasury. So all in all, this then makes NS&I premium bonds one of the most safest investments around. But I guess the question here is, can you get better returns through dividend stock? Well, let's take a moment to actually look at maybe the negatives of premium bonds. Now, just because your money is safe, now that doesn't necessarily mean that it's a good investment, especially after the recently announced price cuts that were made by NS&I. Now, due to these cuts, premium bonds offer some pretty abysmal return rates. Now, the reason I say this is because currently the odds of winning a prize draw is 24,500 to 1. Therefore, to guarantee some kind of prize money, you would need to have at least £24,500 saved up. But even then, the annual prize fund actually only averages out to about 1.4% as an annual return. And then due to the cuts from next month onwards, the odds are 34,500 to 1. Meaning in order to guarantee a prize, you would have to have £34,500 saved up, where the annual prize fund actually only averages out to be 1% of an annual return. But don't get me wrong, that's not the maximum that you'll get from your savings, because you need to remember that these bonds work as a monthly prize draw. So you can definitely win a significant amount of money. However, it's not guaranteed. Therefore, if you are looking to generate a certain amount of money from savings or investing, NS&I is probably not the best option. Now, the other thing to note here is that I'm sure you've all heard the saying about you're more likely to get struck by lightning twice than winning the lottery. But your chance of winning the national lottery jackpot is actually 1 in 45 million in a week with a single ticket, which actually means that making those odds is actually much better than the 1 in more than 47 billion chance of becoming a millionaire through one single premium bond a month. However, the key thing to remember on this point is that when you play the lottery, once you lose, you've lost the money that you've spent on your ticket. Whereby when you're saving your money with NS&I, you still have that money. And if you continually add money into that savings pot, you're also constantly increasing your chances of becoming a millionaire through premium bonds, as every £1 saved counts towards a chance of winning in the prize draw. Now, with an average interest rate of 1% on premium bonds, and according to the Office of National Statistics, the inflation rate in UK as of March 2020 was at 1.5%. So that then means that you're actually technically losing money by saving it in a bank account with a lower interest rate than the rate of inflation. Now let me break this down to you to make more sense. Now let's say you had £100 saved in an account and you were going to make 1% interest that year for keeping your £100 in that account. This basically means that next year you would have £101. Now, how does the inflation rate actually affect this interest rate? Now this is where I actually like to look at the Big Mac index, even though I'm vegetarian. That's right, I did actually say Big Mac, as in the McDonald's Big Mac, because when we look at the graph here, since the year 2000, the Big Mac has actually been a pretty reliable economic measure of the rate of inflation, because as inflation rates increase, the actual cost of things we buy on a daily basis also increases. So back in 2000, with your £100 saved, you could have got 52 Big Macs and then also a fraction of one. But now, in 2020, if you didn't earn any interest at all, you would have only been able to buy 32 Big Macs and also a fraction of one. But if you were getting an interest of more than what the inflation rate was over the 20 years, so for instance, let's say the interest rate is about 4%, your £100 will actually now be worth £180, 1 pence after 20 years. So you would actually be able to buy 57 Big Macs and then obviously a fraction of one as well. But then if we look at the 1% interest rate that you would be getting with your premium bonds, you would actually have ended up with £120 over the 20 years, which means that you would have only been able to buy 38 Big Macs and a fraction of one. Now I don't know about you, but that 4% interest rate looks a lot better than being able to buy less than what I could buy 20 years ago. And you know what? That's just the Big Mac scale. Now if you look at the Freddo scale, it's a whole different story, because unfortunately consumer products does not increase in the same rate as the rate of inflation. So if we look at the Freddo scale, back in 2000, the Freddos were 10p, and you would have been able to get 1,000 Freddo bars with your £100. Now in 2020, with Freddos costing 27p, if you were on an interest rate of 1%, you would only be able to buy 444 Freddo bars and also a fraction of one. Whereas if you had 4% interest rate, at least you would have been able to buy 666 bars and obviously a fraction of one as well. Now I'm sure you can see the trend here. That 4% is going to be a lot more beneficial than that 1%. Now the reason why I picked 4% as the interest rate is because right now the FTSE 100 supports a dividend yield of about 4%, which immediately suggests that the UK dividend shares are going to work out better than keeping your money within a premium bond account. Now this then introduces the issue that most people have about investing in the stock market. And that issue basically revolves around the additional volatility of the ups and downs of the stock market. And quite rightly so, that is true. However, in the long run, investors tend to see extremely high returns. For example, over the last few decades, a diversified portfolio of blue chip dividend stocks would have produced an average annual return of around 8%, meaning that the £100 invested in 2000 would have actually now been worth £280.20. Now, as you would know from my previous videos, the best thing about dividend stocks is being able to truly get passive income. So investing smartly to build a portfolio of high quality blue chip stocks like Unilever and GSK could give you a great balance of regular dividend income as well as capital growth over a long term. Now, it should also minimize the risk of seeing considerable loss in your portfolio. Equally, another approach would be to buy low-cost index funds as well, which allows investors to profit from the average dividends of lots of dividend stock. And this is a great way for people who don't know much about the stock market and want to minimize their risk while maximizing their profits. However, there is possibly another option, and that's combining both NS&I premium bonds with UK dividend shares, which I've already decided to do now as well. To help diversify my investments, I've also set up a premium bonds account and planning to put a small percentage of my money into that as well. Because as they all say, you got to be in it to win it. And the bottom line is, someone does get to win big in the premium bonds. So if you're not in it at all, there's no chance of being able to be that person. And that's not to fear the stock market. And that's not to fear the market pullbacks. The best thing is always to hold on to your investments and then also pick a few bargains while the market is low. Now, obviously, that's easier said than done, which is why I wouldn't recommend investing unless you have saved up a little bit of money to cover you for a rainy day, or weeks, or maybe months, as there is always a chance that things cannot quite go how you would want them to go. But like I always say, I have no financial background at all, and everything I'm saying is just research that I've been doing myself, and it's also the things that I'm doing myself in my own life. But if you are planning to invest in anything, I would always recommend seeking professional advice. Anyways, that's it for today's video. I hope you enjoyed it, and I'd love to know if any of you have premium bond accounts, or maybe your parents set one up for you when you were younger. And more importantly, I want to know what's the most that you have won in the prize draws. So let me know in the comments down below. But if you haven't subscribed already, make sure that you hit that red button and click on the bell so you get notified when my next video comes out. And as always, remember to like the video, comment down below, and share with your friends and family. See you in the next video.